Hello, my name is Matt Pacheco. I'm a tax partner at Burton Company CPAs, located in Albuquerque, Santa Fe, and Taos, New Mexico. Today, what I want to talk to you about is the LLC and mainly the difference between partnerships and S corporations, similarities, the differences, as well as when you might want to consider filing an S election to be taxed as an S corporation. A limited liability company, an LLC, is one of the most popular forms of business to set up these days. One reason is the flexibility that it offers. If it's just you by yourself, you can still be taxed as a sole proprietor. If it's more than one person, you can be taxed as a partnership, or you can choose to be taxed as an S Corp. That's what we're going to focus on today. Now, a lot of people think that a LLC, I'm going to use that interchangeably with the term partnership. Though an LLC taxed as a partnership is the same thing as an LLC taxed as an S corporation. One of the biggest similarities is that both will gather the income, pay the deductions, and what's left over passes through to the owners. It's considered a pass-through entity. And then the owner pays tax on that income. So if you have two partners, each partner will take their share of the income, pay tax on their own personal tax return. One of the big differences in the S corporation versus the partnership is related to how you get paid. In a partnership, you will receive what is called a guaranteed payment, and the rule is actually that you should not be on payroll. I have seen plenty of partnerships actually pay payroll, and I haven't actually seen anybody get in trouble for that, but it's technically not correct. You should be taking a guaranteed payment. With an S corporation, you are required to be on salary and to take a reasonable salary and pay yourself and issue yourself a W-2 for your wages. For purposes of this discussion, we're only going to be focusing on operating businesses. We're not talking about rentals or other passive income. We're talking about businesses that you actually work in. With a partnership, not only does any of the guaranteed payments come out is subject to self-employment, but also the net income of that business that flows through to the owner is also subject to self-employment tax. If you're not familiar with that, that is Social Security and Medicare, both the employee portion as well as the employer portion. Now, if you are an S corporation and you pay yourself wages, the business is only responsible for the employer's portion of the Social Security and Medicare. The employee, which is also the business owner, is responsible for the other half of the Social Security and Medicare. The main difference with this S corporation is that any net income left over that passes through to the owner is not subject to self-employment tax. Whereas in the partnership, all the income left over is subject to self-employment tax. So what does that mean? It means that in both situations, the income tax is going to be unchanged. You're going to still pay the same amount of income tax. The main benefit of an S corporation is that you may be able to save some tax on your payroll tax. Since you can control your payroll taxes inside of an S corp, the IRS requires you to take a reasonable salary. Now, the reasonable salary is outside the scope of this video. It can be a whole different conversation, but it's based on industry standards, facts and circumstances, and what would you pay somebody else to be doing the job you are doing. With salary comes some additional reporting to the IRS. You have to do quarterly payroll reports, you have to file a separate corporate tax return, and you have to issue a W-2. So there are some additional costs that you may incur in order to be compliant as an S corporation. So the major benefit of the S election is related to your payroll taxes. The more profitable your business, the more payroll taxes you can save. Thus, when you're starting out and you are not profitable yet, maybe you're operating at a loss, it is probably not the best time to file for an S election to be taxed as an S corporation, because you would then be paying payroll tax on income or losses that you would not normally be paying tax on as a partnership. One other difference with the S corporation and the partnership is how your basis is calculated, which means how you may be able to use losses in years that are not so great. The S corporation only allows basis for loans, for money you put in as well as loans that you make directly to the corporation. A partnership, you get basis for money you put in, as well as any loans that you have guaranteed, whether or not they're from you. So if you have a bank loan, partnerships make a little bit more sense. If you have a mortgage on property, a partnership would make a little bit more sense. In a partnership, your bottom line, after all the deductions, after the owners pay, that bottom line is subject to self-employment tax. In an S corporation, all the deductions after owners pay, the bottom line is not subject to self-employment tax. That is the key distinguisher. If you are profitable enough to cover some of these extra expenses, it is important to make that S election. However, if you are not yet profitable, it may be in your best interest to wait. If you have any additional questions regarding this, or you want to talk about your specific situation more in depth, please feel free to contact our office. Our number is 505-265-6604. Hope you have found this helpful. Thanks.